Vartak joins us, and let's take our conversation forward. Samit, nice to have you back. It's been a while, we've not interacted. How you been? How things?
Absolutely, my pleasure, Nikunj. Yes, it's been a while. It's been, I think, probably a year since I interacted with you. But absolutely a pleasure to be here.
My friend, I can notice that you're graying. इस market में क्या stress है?
Stress यहाँ पे हुआ नहीं अब. Stress coming down.
It's been a good year for every asset class. I mean, rarely you see gold, Bitcoin, equities, bond, commodities, everything in a sense has moved up in a synchronized manner. Why is that? I mean, financial markets are all about mean reversion. Asset classes never go up together. But it's been a good year for US equities, decent year for startup, great year for Bitcoin, gold has hit a new high, and bond yields have also rallied.
Yeah, I mean, it's really surprising. Even, I mean, it doesn't really make sense because, if you think that risky people where people hide, like gold has gone up, Bitcoin, which is a risky asset, also has gone up at the same time. And I mean, you can understand what's happening in India, but globally, why these asset classes are moving up and it's not even that we have interest rates which have high liquidity, where people would leverage and then come into the market. It's not even that. I guess, people have a lot of money and, people made a lot of money after COVID and they're looking for avenues to invest. And, even after this run up, many are sitting on a significant amount of cash. So I think even now the liquidity isn't, completely exhausted. So I guess it's just the money which was probably printed during COVID times is something which is still making, rounds around.
But Samit, how long do you think, this money in India equities, and now let's get back to the, motherland. How long do you think money is going to, continue to chase markets like India? And is there merit in now taking those tactical calls? Let's get stock specific, or would you say that you're better off taking those larger, market cap agnostic calls as well? Because many believe that it's getting a little frothy now for small and mid caps, ease out from there a little bit, allocate higher bunch to large caps.
Yeah, I mean, see, if you forget the stock market, I think, and just look at the economy or corporate India, there is no frothiness in the economy. I mean, just look at the operating cash flow to sort of the Capex ratio. It's at 2-decade high at 2 times. That means, companies are making so much operating cash flow compared to what they're investing. Even, operating cash flow to depreciation is really, really low. That means, I mean, Capex to depreciation is very, very low. So, which means not too much Capex is happening. Generally, at the peak of the cycle, private Capex peaks up and companies go for, the optimism is so high that companies go for even the low quality investment projects. And then they also compromise on the working capital cycle. Working capital cycle expands, and also they loosen the credit terms. So none of that is what is been observed. I mean, if you see, it's actually opposite of that. We have the lowest working capital days across industries. The credit terms are very tight. And as I said, the ratios of Capex are near the lowest. But in the recent times, if you see last 2 years, the state government and the central government, they had Capex growth. I mean, they contributed to the overall Capex picking up by 20% and 25%, respectively, in FY23 and FY24. Right. So that's a good sign. Now, after a long time, private Capex has started. So last 12 months, the private Capex is up 17%. Right? So these are pretty large numbers that, government spending 20-25% year on year, and then private Capex picking up 17%. Even if you see the approvals in the banking system, mainly for new projects, it's at all-time highs. From year on year, the growth has been about 70% plus, and even in terms of number of projects, it's 30-35% plus. So these are signs which will result in growth. These are precursors to actual growth coming through. Indian markets haven't grown, significantly in the last 9 years. The earnings growth has been in single digits. It's been below 10%, and because of a lot of issues that we have had, in terms of banking, excesses. 3-4 years back, we had the GST rollouts. We had COVID, all of that. So I won't be surprised if the next 9 years, we may make up for that, because our average growth rate is about 12 to 13%. So we may make up for that growth over the next 9 years. And if that happens, I'm sure the money flow can keep on continuing to come into India. And one more, I think, real difference that we need to note is that even though the earnings growth in the last 9 years was just 9%, the operating cash flow growth over the last 9 years was about 15 to 16%. That's pretty high. 15-16% for India operating cash flow is pretty high, and that was exactly the returns of the market. So market returns aren't too divergent from the the cash flows that corporate India has delivered, and we are sitting on one of the best balance sheets, even within India and also I think across the world. Even when you look at the government, the corporate India, and then look at the tax collection, and government is going all out in spending on projects which will deliver. It takes time. There will be a lag effect, but the kind of investments which are going into India will definitely attract a lot more investors going forward. And I won't be surprised if FIIs go into FOMO mode, because they've stayed out so long, and then India is sort of a scarcity asset. There is very little growth happening in the world, and at certain point, FIIs have the lowest sort of holdings in India in terms of percentage ownership in India. Just 16-17%. At highs, it used to be 21%. Right, so that 4-5% difference, if they try to come back, it's buying off almost $200 billion, and $200 billion, I don't think Indian markets can absorb. So let's see what happens, but I think the fundamentals are pretty strong.
But Samit, the point is, what with this fresh money or money which is already circulating in the market actually chase? Because India traditionally has always been a stock-specific market. Now, of course, there are these larger umbrella macro calls which are being taken, better on infrastructure, better on the Make in India theme. What is looking attractive? And also, more importantly, because valuations have run up. These are all discovered pockets we're talking about in the market right now.
Yeah, I mean, that's been a big issue in India. It's the valuation. Valuations in small mid caps are 20 to 30% higher than the last 10-year average. In the large caps, maybe 10% higher than the last 10-year average. I'm talking about the median valuations, not the consolidated Nifty P multiple. So that's an issue, and I think the worst thing about this market is that the less work you do, and the faster money you put into the market without doing real research, the more money you make. And if you waste time in doing really in-depth work, you lose out. The opportunity cost is pretty high, and in such markets, it's easy for investors to sort of compromise on the quality of work that you would do, and hence the quality of companies in which you invest may also be poorer. So I think that's something that one needs to be very, very careful. I will give you an example. I mean, there's no question that things are improving on the PSU side, right? But if you look at the last 1.5 years, the PSU pocket, if you look at just the BSE 500, there are about, say, 80-90 PSU companies. That pocket has gone up by 80%, and the rest of the non-PSU pocket has gone up by 32%. Right? This is median return. But if you look at the operating cash flow in the PSU bucket, it's gone up by 0. And the operating cash flow in the private side or the non-PSU side has gone up by about 29%. So pretty consistent with what kind of returns it has generated. And so I think there are certain pockets. So wherever there is herd mentality, renewables, defense, shipping, railways, power, there are so many of these pockets where you can see stocks have multiplied in the last 1.5 years. Right? So one needs to be, cognizant of the fact that if the returns are too divergent from the fundamental sort of growth in the companies, then you need to be careful. There will be certain winners even in the PSUs, no question about it. But there would be more, many more failures. So in the long run, not many will be ending up making overall money. As a universe, if you are really good stock picker within that, you surely will make money. Similarly, so there are a lot of pockets which are in the sort of non-fancied segments. So whether you look at, I mean, I'm positive on themes like anything which is going to help build India. So build India can be building real estate, it can be building warehouses, factories, it can be infrastructure, anything. But if you focus on companies where there are huge barriers to entries, any material supplier where there are huge barriers to entry, competition won't be coming in. I think next 4, 5, 6 years, of huge capex that India will go through, these companies will be the biggest beneficiaries. If there are pockets where a lot of new companies would be formed, then that would be spread across, and each company may not be making that much probably profits or growth in profits. So there are a lot of such pockets, whether it's in real estate, whether it's in building material, whether it's in sort of financing, especially Nbfcs, which haven't done anything great. So I think so far it's been like the worst time for a good stock picker, because you don't get time to do your work. But I think slowly and hopefully slowly we'll move into that kind of a phase.
Why have you bought into NBFC, especially power finance and home finance? I mean, these are also crowded trades, aren't they?
Right. I think now they are becoming crowded trades. I think in this market, we invested probably maybe less than a year back. Stocks have more than doubled. What we thought will happen in the next 2 or 3 years happens in matter of months, and that's the problem. That even if we were late by a few months, you would have lost on. So we are careful in terms of picking these pockets. So what we look for is always earnings doubling in next 3 to 4 years. And for that, generally the return on equity has to be higher than 18%, and there are very few in especially the Nbfc space which meet that kind of a requirement. And we found that in the power finance kind of a segment, and the growth came through and the biggest change was the improvement in the balance sheet. What provisioning they took over the last 3, 4 years, a lot of them, were coming back. Their market opportunity also expanded because beyond power finance, they also can now finance 1/3 of their book into non-power projects. And then you also have a more, big fillip in kind of renewable expenditure, that we would be doing over here. So there were demand triggers, there were balance sheet improvement. I mean, from a 4% net NPA, it dropped to 1%, and from there it would probably go to 0 in this time. So there are a lot of triggers for it to sort of give you comfort on returns. And the valuation range, historically has been 0.6 times to say 3.5 times, historically. But just a year ago, it was trading at the lowest end of valuation. So one has to be, choosy. And if you wait for the right pockets, there are opportunities. And, that's what we try to do.
Samit, morning. Wanted to get in your perspective as well as to what perhaps the big concern could be for the markets. Do you think that largely it'll emanate from global growth concerns versus any problems domestically?
Right now, I mean, the problem that I see is mostly global in nature, because globally, I think in terms of geopolitics, there are a lot of moving parts. In terms of trade barriers, there are a lot of moving parts. You don't know, next in the next year's election in the US, who would be the next president, and depending on that, the complete dynamics is changing. There is almost like a Cold War going on. There are factions developing. Those can create lot of friction in the global chain. My expectation is that India will be the net beneficiary out of this. So um, I don't know whether China plus one, those kind of things have really played out, but for sure, overall, the way India's competitors, are shaping up, look at Vietnam, look at China, look at Bangladesh, India is definitely standing out. India's resilience was tested post-COVID, and so I think if something completely out of the blue, which we are not aware of, comes out, that would be the biggest risk. I don't really see something which is highly probable. And generally risks are such that you can't predict those risks. Risks which are predictable are generally priced into the market, and risks which we probably don't know are something which will shock us. And we just need to be ready, and you need to position your portfolio so that it can withstand those kind of crisis. If something goes wrong in the election, politically something goes wrong, if there is a war scenario, if there is some other pandemic which develops, one needs to be a little more comfortable in terms of what holdings you have. One sort of black swan event should not just destroy the profitability of the business or destroy the opportunity for your company.
All right, good to have you on board. Thanks so much for taking time out, Samit, and sharing with us your outlook on the markets. A quick